Hello everyone and welcome to Magenta's investment update. I'm Gretchen Betts, MD and financial planner at Magenta. And again this year I'm joined by Tertius Bonin, assistant portfolio manager from EQ Investors, and Laurentius van der Worm, investment strategist from Timeline. Tertius and Laurentius are here to spend some time with us today to answer questions about the markets over the last 12 months, how bonds and equities are behaving, inflation, and what we need to know looking forward for the investment markets. And alongside me is Aled Burd, junior planner at Magenta, to help me ask questions and host this update. So thanks for watching, and I hope you find it useful. The information we provide and discuss in this recording is not to be taken as financial advice or investment advice from either Magenta, EQ or Timeline, as whilst we will try to make this as relevant as possible for most of you, this isn't provided as bespoke personalised advice. And if you'd like to discuss your situation and your investment portfolio specifically, please do get in touch with the team at Magenta and I would be happy to help. So let's dive in. Looking back at the past year, we've seen significant volatility in the global markets. What were the primary drivers of this volatility and how did your respective firms navigate through it? So I'm going to come to you first, Tertius, if that's okay.
Sure. Yeah. Well, I think there have been sort of two quite big stories in the last sort of 12 months or so. We have AI, which has been an absolutely gigantic trend, I guess, for markets. But we also have, I guess, the direction of interest rates. And these have sort of been pulling in two different directions. So AI has been a really amazing trend to observe. This obviously started around the latter half of 2022 with ChatGPT being released. But since then, you've seen every company that's AI related sort of suddenly do so well. So NVIDIA now, the semiconductor manufacturer, is now the most valuable company in the world. So we've really seen a sort of a big shift in markets. Meanwhile, the rest of the economy, the rest of the markets have seen a little bit less excitement. There's been some oscillation, I guess, for the direction of interest rates. Are we going to see higher interest rates for longer? Are we going to see a nice gradual decline in interest rates? And that's really dictating, I guess, where the rest of the market has been going.
And what about you, Laurentius? Anything to sort of add in there?
Yeah, I think, Gretchen, it's always interesting. I've never been in a conversation where somebody told me the markets are now so stable, we really love this environment. That's the markets. The markets is actually volatile. If you look back at expectations about a year ago, we knew we were going into a year where what's it about 45% of the global markets or 45% of all countries went into an election season. That was about 55% of the global population. It's about 80% of the global stock market went into an election year. I was expecting volatility to be much higher this year. I think looking back, we can say that yes, there were certain flare-ups. One of the metrics that we often use to measure volatility is called the VIX index. It's just a volatility index. It's often referred to as the Wall Street's fear gauge. And we've seen a very average about 17% in the VIX, and then all of a sudden that 17% will shoot up to 40% and then drop down to 17%. So we've definitely seen these isolated flare-ups of volatility that was driven by, well, geopolitics, whether it was elections or conflict events in the Middle East, China, Taiwan. There are so many elections with Trump coming in, tariffs again being one of the big talking points around this. So there's a lot of talking points, inflation, interest rates. And I know the big one this year was when there was some economic or negative economic growth data that came out from the US and everybody was expecting a recession and inflation flared up to about, volatility flared up to about 40% and then just died down the following day. So I think markets were volatile during isolated periods, but that's just markets. I don't think we've seen anything extraordinary this year. You're on mute, Gretchen.
I knew I'd do that. Anyway, yeah, so with inflation, we've seen inflation come down, which has been overall good news, had good impact on the market. And then we've, had the recent budget. There's talk of inflation going to maybe go up a little bit more again. And so it is remaining, that key, still a key concern, certainly around decisions that the banks are making around adjusting interest rates. How have these factors impacted investment strategies over the last year, and what are your expectations for the next 12 months? Laurentius, we were talking to you, so why don't we go back to you and then to Tertius?
Yeah, of course. I think inflation is obviously the one big thing that was part of every update, every conversation. Inflation has come down to relatively normal levels. What's the CPI is now down to 2.3%. We've seen a small increase in CPI actually again. You have to remember these things are cyclical as well. So CPI doesn't go down in a straight line. Your core inflation that strips out your more volatile items like energy and food prices is actually still sitting at 3.3%. That's pretty high. So that has had a huge impact in the way that rates were actually lowered this year. I think the expectations was for rates to come down much more aggressively than they actually did. Bank of England now loosening rates by 25 basis points at a time. That's not really enough to have caused a significant recovery in the fixed income market. But we've seen some stability in the fixed income market, especially on your shorter dated fixed income. There were positive returns. I think all fixed income markets, apart from your really long fixed income markets, are positive this year. That's something that's really positive for us going into 2024. I think if we can get control over this core CPI component, get that down to 2%, we will see rates coming down. And I think especially your fixed income market, your stabilizing part of the portfolio, does look really attractive. And those rates should normalize and prices should increase on the fixed income part of the market.
And what about you, Tertius? What's your view?
Yeah, I think I'd highlight the bifurcation we're seeing between the UK and the US. I mean, the US is the world's largest economy, definitely sort of the most important, the most watched region in terms of where interest rate policy and inflation is going. The UK is obviously very important. It's our home market. Has very large implications for where gilts are going and where the sort of how the pound moves. But I think just looking to the US, it's a relatively uncertain path from here. There are still components of inflation, as Laurentius has said, that are sort of slightly hotter than expected. So the core CPI in the US is slightly hotter than maybe sort of is comfortable. But when we look at the outlook, and we'll come on to talk about this, but of potential tariffs, about potential new impulse in economic growth in the US that might be spurred from tax cuts or deregulation, there is some uncertainty as to how tameable that inflation figure might be. So that 2% rate, which is, I guess, the comfortable rate, right? It's maybe a little bit sort of more difficult to achieve going forward. So as Laurentius is saying, that there has been a little bit of volatility in bond markets, especially in the long end. So these really long dated bonds, which are typically, I don't know, 10, 20, 30 years until their maturity. But the short dated part of the market, so this is bonds that mature in the next of, I don't know, 5 years, let's say, that has been pretty stable. They've seen some pretty sort of interesting returns there, and that's a part of the portfolio that's part of the market that we've definitely positioned our portfolios over the last year or so to benefit from.
Thanks both. Next couple of questions are from me. So there's been ongoing debates about the potential for a recession in major economies. How do you assess the current economic recovery, and are you preparing for a downturn in the near future? Tertius, can I start with you?
Yeah, sure. So there's a couple of metrics that we follow for this. I mean, there are actual sort of, I don't know, economic models that people can build to sort of predict how likely a recession is in the future. And there's a couple of these that we do look at from time to time. At the moment, I'll stick to the US as a topic, just as I was talking about it. But the probability of a recession in the next 12 months in the US has dropped significantly. So we did see a bit of an economic slowdown in 2023. This did sort of spur a few discussions in the market. So are we likely to see a US recession? Are we likely to see sort of slowing global growth? But actually, we've seen a re-acceleration of growth in the US. We've seen a lot of these indicators actually drop off, saying that we're not likely to see a recession that's imminent at the very least. It's a different picture, though, I would say, for maybe Europe, Eurozone, and for the UK. So the Eurozone is still grappling with a manufacturing sort of issue around it, a manufacturing recession, to be frank. They're facing sort of higher energy costs, higher input costs. The UK is a bit of a wild card. There was a lot of talk about growth and building and some optimism with when the new government came in. We've seen a pretty precipitous drop in business confidence since. One of the metrics I track quite closely is a survey by the Institute of Directors around sort of, I don't know, optimism for the next 12 months, and that's literally just been like a sharp drop, I think, since the election. So a lot of the goodwill, I guess, that was being built up is sort of being eaten into. But yeah, I'll Laurentius come in.
Yeah, I think Tertius, you've got a much more technical answer than I've got. I think we've got so much out of sync at this time in the economy. If you think about a typical textbook example of an economic cycle, when rates are coming down, that should stimulate economic growth. We are now talking about the economic recovery with rates coming down, but we're also talking about the risk of a recession looming. And as you've said, Tertius, there's a lot of mixed signals out there. I don't think we should bargain on a recession. Is it possible? Absolutely. It's been part and parcel of the system for the last more than 100 years. Well, way longer than 100 years. I think, are there a risk of a recession? There's always a risk of a recession. There's a lot of trigger points that can happen. If you take the Chinese market, for example, the Chinese market has been very flat now for the last couple of years. If you look at well, even economic growth, but the equity market especially. So they are well positioned for very aggressive growth. But then within the market, you've got the property crisis. A property crisis in the Chinese market is something that can bring the whole emerging market or all of the emerging markets down. So there are so many trigger points. That's just in the Chinese economy. In the US economy, you've got the same thing. Something like another bubble or a air pocket in the banking sector can cause another crisis. So yes, there's a risk of an economic recession or at least a stock market correction. Would I position myself for one? Absolutely not. I think our advice would always be to plan for it. Don't try to time it. And how you plan for it, it's just go back to your fundamental principles of don't put all your eggs in one basket. Stress test your portfolio, and when these events show up, just be disciplined, sit tight, because they might actually show up within the next year, or they might not show up within the next 10 years. And positioning yourself for a recession or for a bear market in itself, I think, is the biggest risk that you can take. You should be diversified, and when it shows up, just accept it. It's part of the market.
Thank you both. So we've partly touched upon geopolitical tensions, such as those in Eastern Europe and trade. So just out of interest, how have you factored in future geopolitical tensions into your investment decisions? And what geopolitical risks do you foresee in the upcoming year? Shall we start with you, Laurentius?
Yeah, thanks, Aled. It's interesting. I think it goes back to my previous answer on um, control what you can control. So what we typically do at Timeline, we are very much focused on the actual stress testing historical or stress testing your portfolio against historical scenarios. And when you do that, let's say if you stress test your portfolio against the last 100 years, you are now stress testing your portfolio against some pretty dark times. Think about the 1915s, World War One, Great Depression, World War Two as you go into the 40s. Those are bad times. Your 9/11 terrorist attacks, your 1970s stock correction environments. If you can stress test your portfolio against those environments and position yourself for similar events, then I think that is probably the best way to go about it. It's a fact that geopolitical tensions is elevated. It's much higher than your historical norm. And that could be due to several reasons, as we've mentioned, the trade wars going on between the US, China, European China, the conflict in the Middle East, the conflict in Ukraine, all those things, it does cause market volatility. What we've seen is we've done a bit of research into how the markets have reacted after past geopolitical events, and that would be typically your invasion of Crimea in 2014, the invasion of Ukraine in 2022, etc. Those types of 9/11 events. And what we've seen is that the markets are reacting quite aggressively to these events. But it's more noise than anything else. The noise of the market is being faded out normally over a 3 to 6 month period, sometimes extremely rapidly. If you think about COVID-19, the average market was down about 30% during COVID-19. The recovery was 3 months on average globally. So yes, there's elevated tensions in the market. We think the markets have a very, very good way of correcting themselves very quickly. So be prepared and just wait it out.
I think I just to come in, I echo a lot of those comments. The likelihood of second guessing the next COVID, the next sort of Russian invasion of Ukraine is next to zero, right? These are external shocks. They're notoriously difficult to forecast, if not impossible. No one has a crystal ball with these types of things. There are clearly some large risks on the horizon that could derail the current sort of narrative. But I think really one of the best ways that you can factor these into your investment decision making is really to make sure that you're not taking any unanticipated, unexpected sort of risks in the portfolio. So it's as you say, as Laurentius says, stress testing the portfolio. It's looking at sort of a technical bit of jargon here, but looking at your factor exposures to make sure you're not exposed into parts of the market that you don't necessarily intend to be. So that actually, when there is a sharp shift in the market, you can sort of be relatively confident that your exposures are where you expect them to be, and sort of you can ride the volatility in a measured way.
Thank you both. Back to me then. This one's specifically about sustainable or ESG investing. So we'll start with Tertius, but in regards to sustainable and ESG, how have investments performed in the past year? And do you see any changes in how clients are approaching their ESG thinking, the criteria they want, and about their portfolios moving forward generally? What's your experience this year?
So I think sustainable investment has come a long way in the last 12 months, right? I think the performance, I think is maybe the sort of the most obvious measure by which you can sort of talk about this. It is certainly improved versus maybe sort of how it was in 2022. Talking just now about sort of unintended risk exposures, I think there's some parts of the sustainable investment world that may have got caught out there. I think there's been a lot of maturing, and actually looking forward, there are a lot of reasons to be optimistic, I think, about how sustainable investing can sort of weather the crisis going forwards. I think there has been a lot of narrative building around sort of sustainable investing, ESG trends, maybe particularly as you see the election in the US and sort of the narrative that comes out of there. But actually, demand is growing amongst clients. And the global challenges, I guess, that these sustainable investments are trying to address, they're only getting more acute in some areas. So while I don't know, these challenges are often the end markets for a lot of the companies in the kind of portfolios we run, and these challenges are getting more acute, meaning that the end markets are growing. There is a growing financial case, I guess, for sustainable investing as we look forward. And I think just coming to ESG, it's becoming, I think, almost common sense to be integrating this within your investment decision making. It shouldn't be contentious to think about whether corporate management teams have bribery track records or whether chemical companies are spilling into rivers, right? That shouldn't be sort of a contentious thing to consider when you're making investment decisions. So actually, the future of ESG, I'm very, very positive on.
Good. And I agree with you, Tertius. I think ESG, we've been, especially in the retail market, ESG is actually not such a new thing globally, especially on the institutional side of things. But in the retail market, it's fairly young. And it has gone through a cycle of people trying to find their reason for investing in ESG. And we've seen over the last couple of years, especially in the early days in your pre-COVID and early COVID era, where investors were flowing into ESG and basically to chase enhanced returns. And our view is that that's not the right reason to go into an ESG portfolio. If you want to chase enhanced returns, do that in a tested method that actually, in an evidence-based method that does give you actual expected or higher expected returns. ESG is there as a principles-based investment tool. And what we've seen in the last year or two is investors actually realizing that. I think 2022, as you've mentioned, Tertius, has played a huge role in that, where ESG factors or ESG companies have done actually quite well. And then 2022 came and we've had the energy crisis where your energy stocks all of a sudden were doing really well. And then all of a sudden, these ESG investors that were chasing returns were now flocking to energy stocks, the complete opposite of what the or ESG stocks actually represent. And then you had the financials crisis or the banking crisis with Silicon Valley Bank also had quite a significant effect on ESG portfolios. And I think this year it has become much more principles based. People are investing in ESG because they do want to have that moral, ethical leaning towards these companies that are making the world a better place. And that's definitely something that we are seeing in our portfolios as well.
Great. So certain sectors like technology and energy have had varied performance in the year. We know technology, I mean, the amount of times we talked about the Magnificent Seven and the growth in the market this year has been massive. And we know that certain energy stocks certainly have struggled. So which sectors do you believe are poised for growth in the coming year and which might face challenges? And in particular, do you think there's a chance of a tech bubble bursting? Because that's a question that I get asked a lot. So, Laurentius, what about you?
Yeah, I think Gretchen, if you look at something, we call it the Magnificent Seven. Your largest seven. It's not really your largest seven, but your most influential seven stocks these days. Your likes of Tesla, Nvidia, Apple, Microsoft, Facebook, Google, Amazon. I believe those are the seven companies. Um, are their prices irrational at the moment? Absolutely. They are extremely high. The valuations are extremely high. Um, that said, I think only a fool would bet against these markets, bet against the US. Can they carry on the global market returns for the next year or for the next 5 years or even the next decade? Absolutely. So, looking at the Magnificent Seven, it's a very interesting market, or looking at big tech specifically, it's a very interesting market. Yes, these companies are overvalued, but they are still making a lot of profits. The profits that these companies are making is unprecedented. If you think about companies like Nvidia, the company has a return on equity, which is now a very technical term. It's just a way to express your net income in a percentage term of 147%. That is extremely, extremely high. So some of these companies, even Amazon, which is not deemed a very profitable company, are making profit margins of up to 9% these days. So yes, it's still very attractive. I think these tech companies can continue on. I've got a friend that's a analyst in a or a semiconductor equity analyst, and they are analyzing these companies inside out and actually doing a really good job. And he always tells me, remember, a bubble is something that bursts and doesn't or stops existing. He would much rather refer to it as an air pocket. Yes, there might be an air pocket in the system. Yes, there might be a stock correction. I don't think we are seeing the tech sector collapsing at all. There might be some air pockets in the system, but I think going forward, that is a very big part of any portfolio's future.
No, I like that a lot. Yeah. Tertius, what about you? What's your view?
Yeah, I was going to say you just wouldn't bet against these companies. I mean, there was an adage. What was it? It was the market can stay irrational longer than you can stay solvent. And this is, I think, coming back to it, just don't bet against some of these really big names that have done so well. I mean, as Laurentius says, they have the earnings to back it up. This is not like the previous sort of tech bubble we saw in the early 2000s. The earnings are there, the sales are there, the growth is there. But I think what's particularly interesting, and I wouldn't point to any one sector that's going to do sort of particularly well in the next 12 months versus technology, but there is a broadening out of this of earnings and that is starting to emerge. And what I mean by this is if you look at the last 12 months, the story, the only game in town has been the Magnificent Seven, really. I mean, they've been growing on average, I think, around 50% year on year. So that's unprecedented levels of growth, really. If you look at analyst expectations at the moment, I'm not saying these guys are always sort of 100% right about these things, but if you look at analyst expectations over the next 12 months, the earnings growth for the Magnificent Seven is basically going to half down to around 25% or so, which is still a very respectable level of growth, right? But that for it to come down that much is very interesting. But meanwhile, what you're having is an acceleration in earnings growth expectations for the rest of the market. And that is where you start to see sort of more interesting sort of opportunities pop up. So while this may point to the Magnificent Seven not doing as well as it has done in the last 12 months, I still wouldn't bet against them and say that they're not going to be a game in town. But the rest of the market is definitely looking pretty compelling going forward.
Thank you both. So following the recent election, there's a lot of noise in the press about the possible Trump effect. What are your thoughts? And should we start with you here, Tertius?
Yeah, so I wouldn't go as far as to sort of predict winners or losers on an individual basis. I think my crystal ball is a little bit cloudy at the moment, but I think like Trump's rhetoric is always been slightly different to his actions. He likes to think of himself as a deal maker. His judge of success for himself is typically been the performance of the S&P 500. So actually, as an investor, if you're investing in what the main guy in the US is judging as his own sort of performance indicator, that's not a sort of a particularly bad place to be. Ultimately, he's a president who sort of values wealth creation. He has promised sort of tax cuts, deregulation. Make of that what you will. I'm happier living in the UK than the US maybe, but it's definitely an interesting place to look for to make investments. Laurentius, I'll hand over to you.
Yeah, it's always a difficult question. I use it, and you can ask any of my friends. I will always tell them there are three things that I don't discuss: politics, religion, and rugby. Because I think all of that is just religion, and you can't persuade anybody to think the way you are thinking. And I think if you ask somebody about the Trump effect or what the Trump, it very much depends on your political beliefs and something. But I think sometimes you have to pull yourself outside of the box and give an honest answer and assess the situation. I think if you do that, you will realize there's pros and cons to a Trump presidency. The pros, Tertius, as you've said, the markets are definitely pro a Trump government, especially when I say the markets, the US markets. Globally, there's a very much a mixed response. But definitely the US markets are pro a Trump presidency. He has shown good leadership when it comes to US markets. And as you said, that S&P 500 is his success gauge. So that's something that he will try to, it's his favorite thing to go on and say the S&P 500 is at record high or record highs. But then if you look at the other markets, the European market, maybe not that positive. The European market can be a bit more concerned around things like trade tariffs. I'm not a big fan of trade tariffs. I think that's a age-old thing that has a negative impact on prices. Doesn't matter who is paying those tariffs. At the end of the day, the consumer is paying it. So that's not a good thing. That's going to put downward pressure on corporate profits. On the emerging market side as well, especially tariffs, especially from China. But then also a Trump presidency seems like it's another thing that they do tend to want to strengthen is the US dollar. And a strengthening dollar, again, can put a lot of pressure on emerging market debt. They usually pay down their debt in dollars or take out their debt in dollars. So it becomes more difficult for emerging markets or your struggling economies to pay down their debt. That can be a negative. I think overall, it's a mixed feeling. The US is driving global market returns. From that point of view, it's probably more positive than negative for your investors.
Perfect. Thank you very much. Appreciate that. More of a difficult question. So another question for me, you've both touched upon both AI and technology and developments of both over these past few questions. So how are you incorporating technological advancements into your investment strategies? And do you view AI as an opportunity or a risk in markets moving forward? Maybe start with you here, Laurentius.
Yeah, thanks, Aled. I think it's interesting. So if you are a investment manager or highly active, I'm thinking now of your hedge funds or your high frequency traders, the guys that are making hundreds of decisions per day. I think that's where AI becomes really attractive for them because they can do so much more without that human touch. We at Timeline always say we follow the unsexy approach when it comes to investing. We are much more passive, index based. But even in your index funds, AI has become a massive tool in order to trade more efficient, not to cause these huge amounts of slippage, i.e., prices coming down because of you trading. So AI has helped quite a lot with that. It helps you to bring your trading costs down. So the investors are getting a lower cost at the end of the day. On an operational level at Timeline itself, we do use AI quite a lot when it comes to managing the portfolio, looking at when to rebalance the portfolios, helping with the rebalancing of the portfolios. You don't now have to do it on a specific date in the year just because it's the 1st of January. You can now actually do it at the optimal time in the year without a significant amount of human power or human touch actually needed to be involved. And then also things like chatbot services. There's a lot of questions that's actually usually when you say the word chatbot, the first response that comes up is no, we don't like that. We want to talk to a human being. There's actually a huge amount of questions or stuff going through any company system that's much more efficient being answered by a chatbot because somebody just want to a point of direction somewhere. The chatbot can be extremely efficient, extremely fast in doing those things. So those are examples of how you would integrate AI. I think at the end of the day, people often say, "Well, we're now in a game of man versus machine," and I always like to say that's actually not true. I think at the end of the day, it's going to be man with machine versus man without machine. And I think if you position yourself right with AI, that can be a huge, huge benefit to any company.
I think I mean, as Roger says, there's multiple layers here, right? So, an AI actually itself is a bit of an umbrella term for, I don't know, anywhere from some advanced statistics on one side through to, as you say, like chatbots or whatever it is. So, I think we're approaching AI, the whole space, with a bit of caution, right? I think in many ways, especially in the more advanced areas, we'd rather be a little bit late to the party and I don't know, let it be a tried and tested technology. Because the last thing, but one of the things we take very seriously, and I think most financial services companies do, is data security, right? And the last thing you want to do is be using sort of, I don't know, nascent AI technologies and then risk some issues around your data integrity. So I think that's probably first and foremost in a lot of client relationship managers' minds, at least for using these techniques. But as Roger said, I mean, AI, or at least sort of advanced statistical sort of models and whatever it is being used in so many different places. So the trading is one area. We're seeing some asset managers out there using sort of really advanced models and I don't know, picking up I don't know, large unstructured data sets. I mean, that's the sort of typical technical language. But you could be like, I don't know, analyzing credit card spending. It could be analyzing sort of satellite data. These sort of large data pools are prime for AI to go and sort of pick up new data points that have previously maybe sort of not been analyzable. So it's very much on the radar of a lot of big asset managers out there. These are typically partners who we are working with when we're building portfolios.
Great, thank you. Right, last two questions then. In an era of constant change and uncertainty, what has been the most surprising or unexpected lesson that you've learned about markets or investor behavior, and how has this influenced your approach to risk management? So we'll stick with you, Tertius, because you've just been on. So
I think that the biggest lesson for me is, or certainly over the last sort of 3 years at least, is how rapidly market narratives change, and then how consequently sort of how rapidly markets then react. We saw this in the 2020 sort of the pandemic era. It was a very rapid shift when sort of the first lockdowns were announced, and then suddenly we got to sort of peak anxiety with the markets falling, and then markets rebounded very, very quickly. I mean, they raised the losses from the very start of the pandemic. I mean, within a number of weeks or number of days even. And we saw a similar sort of very sharp, very sort of quick shift in narrative in 2022 as the sort of inflation regime sort of was changing, and people were talking, or they moved from talking about, I don't know, is inflation going to be transitory? Is this just a sort of a small wave, to, well, we could see inflation peaking here in double digits. And that change in narrative again was very sharp, very quick. If you look at sort of how markets reacted, all of it was in just, I guess, a month or two at the very start of 2022. I'm gonna parrot one of our sort of more experienced investors here, but he always says that investors take the escalator on the way up and then the lift on the way down. So it's always very sort of sharp, very quick to come down. I think that's definitely been sort of one of my biggest takeaways. How this then influences maybe the risk management side of things, but we've spent a huge amount studying our own portfolios in terms of unintended risk factors, stress testing, as Laurentius sort of mentioned earlier, scenario analysis. So actually, if X happens, what might happen to the portfolio? So we're wanting to know, I guess, in so many different ways, what the portfolio is going to do and I think you just have to be completely on top of that and know and expect sort of what will happen going forward.
Yeah, I think I would say the biggest lesson that I've learned this year as well, Dash, is it ties in with your lesson, but sometimes you relearn a lesson, something that you already know, but it just sort of re-emphasizes or reinforces or shows you again how important it is. And I think that the lesson that we've learned is the power of emotional behavior when it comes to investing. And we often think we need to educate the end client or the retail investor that might not have a very big financial awareness, and you have to educate them on how to stay disciplined, how to not allow emotions to take over. What I've seen this year is actually that it counts for everybody. It counts for financial professionals as well. Well, I would say especially for financial professionals actually making the day-to-day investment principles. We've seen events where after elections or after certain geopolitical events where certain financial advisors or investment managers would really allow or would allow themselves to move in a way that would suit them best and not necessarily take themselves out of the box and make an independent decisions, put your emotions aside. And that's something that I think is something that's why you need a rules-based approach when it comes to investing. You cannot look into a crystal ball. You are going to allow your emotions to take over. We are not made out of rock. And so a rules-based investment approach that has become very, very important these days. I always say the one example of or the best outcome that we've ever seen, a real life example of a rules-based approach was in 2022 when Russia invaded Ukraine. And everybody was asking us, do we have any exposure to Russian stocks? We should sell out now. And we actually, at that point, or a month before the invasion, we had exposure to Russian stocks. But because of our rules-based approach, the markets were expecting the invasion, liquidity dried up. And because liquidity dried up, all our index funds have sold out of Russia. So trust your rules-based approach. Once you have a solid rules-based approach in place, that will serve you well. You don't have to intervene into in your approach. And I think that again, that stress testing part becomes crucial when it comes to following that rules-based approach. I always, lastly, Gretchen, I always like to use the example of we've got a chart, and everybody has probably seen an example of this chart. We have the stock market shown in bull markets and then also in bear markets. And I always like to say that chart is so important reactively when you're on a bear market and everybody starts to panic. Just show them actually keep calm. We will go through. There's a much stronger bull market following. But I think it's even more important showing that or using that chart proactively, showing people that these bear markets, that's part and parcel of the system. That's the risk that you have to accept in order to share in the upside. And I think that has become very, very clear this year that you just some risks you just have to accept. You can't time them.
Yeah, absolutely. So as we look forward to the next 12 months, what do you see as the most significant opportunity that investors could be looking at? But that, most of the people watching this, they're not going to go out and do it. You guys are going to do it. So what, are you looking at? And bearing in mind your answer about the rules-based thing, I understand we are working within parameters. And, are there any emerging markets or asset classes or factors, which was a word that came up earlier with Tertius, that you believe timeline, in EQ believe are particularly compelling for people?
Yeah, I think Gretchen, if you look at the opportunities in the markets, if you have to imagine you've got a crystal ball, I would say markets moving towards rationality. That doesn't mean necessarily a sector sell down or a stock market sell down, but definitely investors trying to find companies out there that's at a discount or at a good value. We tend to refer to it as value stocks. I think we've seen value stocks actually making a strong comeback, investors becoming less irrational. That doesn't mean you're going to sell out of the Magnificent Seven. The Magnificent Seven, Apple is a prime example, can actually become a very, very good value stock. Same as Facebook. So I think more rational investor behavior is something that we can expect going forward. Emerging markets always quite interesting. things like China, we spoke about it. It's very difficult to predict. I think there are certain parts of the emerging markets that are extremely attractive, especially South America has a few interesting countries that are well poised for really good returns. And then ex-Asian or ex-China Asian countries like Vietnam, India even, these companies or these countries are really well positioned for some strong economic growth. And then also the tech and the AI industry is something that I wouldn't ignore. I think that is a really, really interesting market that we should keep an eye on.
So I think that there are reasons to be sort of, I don't know, nervous and reasons to be optimistic going forward. Maybe that's a nice balance to but to sit on the fence for a little bit. But I mean, it's clear that I don't know there is rising global instability. It's clear that there is sort of uncertainty around the path of interest rates. Are we going to see a plateau where we are now? Are we going to see sort of gradual decreases? So there are a lot of questions, I guess, that are unanswered from here. As we said, though, we do have an incoming president who likes to measure his success based on what the US stock market is doing. So that, I mean, frankly, that's a positive, right, for markets. But the risk of things like a tariff barrier or tariff wall being erected around the US is a concern. But I think once you start to dig down actually and think about the consequences, that there are opportunities that have maybe a new tariff barrier might create, right? So one part of the market in the US that is likely to be relatively insulated is US small companies. So these are typically very domestically focused companies, no real international supply chains. They don't sort of do much sort of international sort of exports or business. So they could be relatively insulated. And actually, then if we do start to see big tax cuts, deregulation, it's these smaller businesses that actually could disproportionately benefit. So I'm not saying, I don't know, let's all go to US small cap. But I think it is an interesting area of the market going forward. And throw into the mix then any companies in the US that are highly involved in infrastructure spend, which is bipartisan sort of support in the US. Everyone wants to spend more on infrastructure. There could be some interesting opportunities in US equities.
Great. Well, that's all my questions, so you can relax now. Thank you. Is there anything you feel like adding? Anything you want to say that we don't feel that we've said? Anything you'd like to end on?
No, I don't think there's anything else to add on. I think just to support what Tertius have just said, any company that's prone to large expenses is going into an environment that becomes more, well, any company or country is prone to a more attractive environment. Rates are coming down. That will have a positive impact on your smaller companies with large amounts of debt. Those debt financing is actually becoming affordable. Countries with a large amount of debt are becoming more affordable again. And then even consumers, mortgage costs are coming down. So I think there's definitely, I think last year this time, or especially 2 years ago this time, there wasn't very much we could talk about, or it was very difficult to find a silver lining around the clouds. I think going into 2025, there's definitely a silver lining, and investors and consumers can be optimistic.
I think as well, it's very easy to hear the word uncertainty about markets going forward, and I don't know, feel anxious. But I mean, I struggle to think at any point in recent history, at very least, when there's not been uncertainty going forward. And it reminds me that I guess if you and I think Laurentius sort of mentioned this, if you look at a long-term chart of the market, right, there are various points that you can draw. From the tech bubble bursting, you could have the 9/11 terrorist attack, you could have the invasion of Iraq, GFC, you could have COVID, whatever it is, Brexit. But actually, the best strategy in all of these cases has been to remain invested in the market. You take the volatility. If you're in the right risk profile for your own sort of personal circumstances, then the best strategy really is being in the market for as long as possible. It's time in the market that's important.
Absolutely. I couldn't echo, that more. Time in the market. None of us have a crystal ball. I like the fact that you called yours cloudy, Tertius. I'm going to use that in the future. But yeah, absolutely. I couldn't agree more. I think there's good chance, and we should be looking forward with some cautious positivity for 2025. Given there are things that we can't change and things that we can't predict, But as things look, I think you are set for, you know, a pretty positive year all round. So thank you so much for joining us today. It's always really great to talk to you, and thank you to Aled for helping me out. And yeah, we hope, well, and no doubt do this again next year, but thank you very much.
Thank you very
Pleasure.
much. It was great being part of this.